back to the Balancing Act podcast with Singer Liwak, a podcast designed to keep you informed about important business developments so we can assist you in achieving success for your company. We're glad to have you back. In today's episode, we are joined by Tony Cardiel, the Managing Director for the SL Biggs division of Singer Liwak. SL Biggs specializes in services in the areas of insolvency, litigation support, forensic accounting, trust probate accounting, fiduciary services, valuation, and business operations management. Tony is joined by guest Paul Carroll, who is the founder and CEO of Avion Wealth. Paul is the author of book Tips and Traps: Selling Your Business While Maximizing Your Wealth. Together, Tony and Paul will discuss the best practices for small business exit planning. Keep listening to learn more.
Welcome, everybody, and thank you for joining us on the Balancing Act. Today, I have Paul Carroll. Thank you very much, Paul, for joining us today. I'm so grateful that you're on and excited that you're here and able to do it. So one of the things that came to mind and that I was excited to talk about is your book that is called Tips and Traps: Selling Your Business While Maximizing Your Wealth. What inspired you to write this book?
Well, let me give you a little background. Our firm is really focused on small business owners and C-suite executives. What we'll do is, using a consultative approach, working with a team of experts, we help our clients not only protect their wealth, but mitigate taxes, protect the assets from being unjustly taken, maximize impact. And when we're working with some of these new clients, very often they're coming to me and they've just sold a business. The problem is it's too late. I can't fix anything that's been done. And often strategic errors have been made that frequently lead to very unpleasant surprises. And after watching this happen to more than one client, I decided, this is a topic for writing a book, not written by a business broker, but by just a third-party observer.
Well, I think that it's a fantastic book. I've gone through it several times now, and that's one of the things that I see is that the business owners, they don't really know where to start.
When we work with our clients, we have adopted a consultative approach where we work with a team of experts. And full disclosure, if selling a business is part of it, Tony, you've worked with some of my clients and helping them get a realistic assessment of what their business is worth. The whole concept of having a team when selling your business, and I call it, there's actually a chapter, your dream team, is you want to have identified well in advance who you would use. What normally happens, even if someone's kind of looking, all of a sudden there's an offer, and it's this mad scramble to put together this team of specialists who can help make things happen, and ideally to the maximum benefit. And an insight the seller really needs to know: are you the client, or is the deal the client? And what's happening in these deals is referrals are being made that are mostly just friends of the other professionals involved. And there is a point where there is so much at stake and so much based on just making the deal happen that sometimes the interests of the deal comes ahead of the interest of the seller. And that's why I'm so focused on making sure your ducks in a row, you got a good dream team picked out long before this happens, even if it's just a list of 10 names you got in your back pocket.
I do a lot of business with not so much business brokers, but definitely a lot more investment bankers, right? But that's part of the reason why investment bankers bring me in. They try to bring me in early because that exact situation that you mentioned. That also brings to mind, the clients that I prefer to work with are the ones that still have some time to implement things that can really increase the value of their business before it goes. But I've seen you walk many different clients down this process. Maybe you can tell us about one of the favorite stories you have as far as the exit.
One of the reasons I like to use an independent, say, evaluation specialist like yourself, is because usually the valuation specialist comes from the business broker. But that's kind of like having your realtor tell you how much your house is worth. Are they really telling you what it's worth, or are they telling you what you want to hear? We all know horror stories of people whose, in this case, houses have been overvalued and just languished while the market turned. Now they're really hurting. But sellers are an interesting bunch. Most business owners are careful with their pennies. That's why they're successful. And so now they're selling a business that's worth maybe $10 million. And I'm like, okay, well, this is not the time to be saving pennies. I've seen a couple of cases, and we talk about this in the book. We talk about the different kinds of buyers. And one of the more prevalent buyers in this environment are private equity. Often they're roll-up shops. It really depends on the end goal for private equity. If the private equity company is just trying to aggregate 4 or 5, let's say, heating and air conditioning companies, they may be a good company to work with because they have a strategy success of your business as a part of an even bigger entity. But often these companies are looking just to flip. And so they're trying to squeeze to make this deal work, make the numbers most attractive. They're going to squeeze. And one of the places they often will squeeze is the seller. There's a lot of language in the deal, as you know, Tony, that requires performance past the date of sale. If they're sophisticated and the seller is working with an attorney that maybe isn't as strong in this field as they need to be, where the buyer can really come back and take back some of that money, or maybe not pay you, depending on the wording of the agreement. And I've seen lawsuits that were quite egregious. They crossed the T's, they dotted the I's, they met the requirements, and they just sued anyway to see what would happen. So some of these buyers can be quite, I don't want to say unfriendly. I think it's more just amoral. That to them, and everything's fair in love, war, and buying a company. For the purchase and sale of a company, there's no state organization you can complain to.
If your business is done well, you're not selling it to someone that's never ran a business before or doesn't have experience doing it. You're selling to a professional buyer that has that team full time, that has the attorney, that has the CPA. They know what to look for. They've done it over and over. You want to make sure you're working with the right people as far as buying.
If I may follow on, Rumsfeld once said, "There's known unknowns and unknown unknowns." You really don't know what you don't know, and you hit the nail on the head. A lot of people are overconfident. They're successful entrepreneurs and businessmen, and this can't be that difficult. I've been buying and selling stuff my whole life. This is a unique skill, and unless you're selling your third, fourth, or fifth business, odds are you need really, really good help. And ironically, I'd say someone selling a fourth, fifth business still needs good help. They just know who that good help is.
Right. Well, it goes back to your idea of the team. Even selling a house, right? You have a team. And even though you might not know it, right? But you've got a realtor, you've got a photographer, you've got some sort of web person, all that stuff to help take your house and market it. Well, you need those same things, maybe even more so, definitely more so when you're selling a business.
I think if I may digress a little bit, another challenge, the expectations of the business owner are often completely out of whack with reality. And we've seen this with people. Maybe you own a classic car, or you bought a house and you put in as much money into the house as you paid for it. These buyers are just looking at net present value of a stream of future revenue. They could not care blood and tears you put into that business. They only care what is the cash flow that can come out of the business. And once it's got momentum, you lose your power. Your negotiating power after the initial letter of intent, it fades from that point on. At the purchase and sale agreement, you don't have any more leverage, so to speak. And these very skilled actors know how to play your emotions, know how to play, basically how to play you. And if you're aware of this, if you're savvy, your pushback at the right time, your appropriate response, not reaction, pretty much signals to them, okay, that's not going to work. We're just going to stick to the numbers here.
I'm thinking about your perspective there. It's very defensive, but at the same time, I don't see a lot of people thinking about it in that way, and that's actually important because it does happen so often, right? So many people are just excited to be part of the deal, right? And it's very important to be thinking about those different aspects of it. And that is another part. You brought up the emotional part that I see over and over and over again is someone that's owned a business and they've been the CEO and the guy, or sometimes, the lady for decades. And then now they don't own the business anymore. They don't know what to do themselves.
Yeah, one analogy when we're working with these deals that I like, I think most successful business owners over a long period of time, through not only sales and organization and communication skills, but also fundamental integrity. I mean, let's face it, companies that play shady games tend not to stick around. And most people who work from a base of integrity assume that everyone else does. And it's like being in a relationship with a very attractive member of the opposite sex, who it turns out after 6 months is an extremely manipulative and narcissistic individual, because you didn't see it coming. That's the only example I can think of, but this is the way it is with these business sales. They don't know what to do next. The year or two after the sale, the year and two of the earn-out period, it's a very interesting year for different business owners. And I've seen all sorts of different outcomes. People have got so emotional and emotionally connected to the business. It's like a limb. It's like in some cases, it's more important to them than their children, though they'd never say that. It's like a house is just bricks and sticks. The day it's sold, it's not yours anymore. And you're going to have to stand by and watch people make what often appear to you to be completely asinine decisions. Most companies, when they bought, they want the previous founder to stick around for a year or two to help with the transition. That's a hard year for many founders.
Right. Yeah, because they can't not to do everything, right? Like, even though it's usually just to handle the relationship. One of the things that I wanted to revisit, because you mentioned that a lot of the business owners don't understand the value, right? They're shocked by how little the value is. And what I see and what I tell them, because I do this a lot, where they're surprised that it's not worth more, is that they are so used to the risk, right? Risk, it's just like, a stock, really. The more risky a business, the more or the less that business is going to be.
Of course, as you know, the value of a company is just it's the hypothetical value of the cash flow. And how do you turn a series of income, an annuity we call that, not an insurance annuity, but how do you take an income annuity and value it? You discount it using an interest rate. And that interest rate is going to have the risk embedded in the company. It really is that risky. And when they get that number, they're thinking my business is worth 10 million and they hear 7. Well, this is why it's so good that they worked with you, not a business broker. Because let's say the business broker really wants the commission, overvalues the businesses to get the transaction, and then talks you down from the 9 million valuation they gave you, which was still less than what you expected, to the 7 during the back end negotiations. Well, that person hasn't served you; they've served themselves. You've ended up with a number, and you are now very upset. The other part of the problem with selling a business, it just shocks the hell out of me. I'm sure it does you too, Tony. Is the taxes. You don't get to sell a business, not pay tax. This is more self-evident to people who bought the business and have grown it some more and now are selling. They understand that they have a basis that they paid for the business, and that the increase is capital gain. They've got this instinctive understanding. Someone who started a business from scratch, they don't have a basis, so they have a negligible basis or value invested, for want of a better term. They have a $10 million gain. And they almost always think, if they even think this hard enough, well, it's capital gains. But it's only capital gains if you sell the stock of the company. If you sell it piecemeal, if you sell what they call the assets, then it's ordinary income. And of course, your average seller is going to say, oh, I'm not selling the assets, I'm selling this going forward entity. But that's almost certainly not the way it's going to work. Most buyers, they don't want to buy the stock unless there's an overwhelming reason to, because when they buy a company instead of the assets, they're buying the liability tail that goes with it. You might have done something 7 years ago that you could still be sued for. They're buying that lawsuit or the lawsuit risk. And so most entities, certainly private equity and others, will do this. Now, there's a section in the tax code, and I was just thinking about it. If I had a little time, I'd look it up, that actually enables you to make an asset sale look like a stock sale. And so often private equity especially says, oh yeah, we'll do a stock sale. And what they really did was an asset sale under this one exemption, and you still get hit with the ordinary income. Now, you're talking about, even in Texas with no state income tax, you're up to 37%. I mean, you're almost certainly going to be paying top marginal rates. If you're in California, you're over 50. You got 10 million? Great, nice. You got a little under 5 in the bank. As you can imagine, someone who's expecting at least 7 or 8 because they think they were going to pay capital gains, that's a real body blow. And they're often out of position where, when the dust is settled, the business was worth more to them than the cash, had they figured out somehow.
Well, I think the business is always going to be worth more to the business owner because they're so used to that risk, right? That inherent risk. But you got, there's so many business owners right now that are in the spot where if you don't sell, if you wait too long, you can't sell it. You'll pass away, and then you're screwed, right? Or at least your family is, if you don't cash it out, or at least have a really good plan. There is one thing in your book that I don't quite agree with, but that might be a personality. Chapter 11, keep it on the QT. What do you mean by that?
Really, this is situational. Yeah, I interviewed 40 people for this book. And keep it on the QT means keep it on the download. Keep it quiet while you're in the middle of these sales. However, every business is different. And I'll tell you, usually when the word gets out, guess who's the one that leaks it?
Probably the secretary. Or
actually, it's usually the owner himself that's so freaking excited they just can't keep the mouth shut. And I got more varied opinions on this topic than any other topic. And my advice is keep it on the QT until you determine it's not necessary. Because once it's out, it's out. And it may be in some business, it doesn't make any difference. Who cares? Now, keeping it on QT doesn't mean don't have counter offers or other buyers. It just means that the challenge, let's say you're selling a heating and air conditioning company, contracting company. Great example for the company. You would probably want to keep it quiet. The minute your employees know you're in negotiations for sale, they're going to experience what I love to call FUD, fear, uncertainty, and doubt. And guess what employees do when they experience FUD?
Right, they start moving.
They start looking for another job. It may not even pay anymore. They don't want to find themselves on the street. So you've got a big challenge, and it doesn't mean that you can't counter that with communication, but at least as late as possible, the longer you can hold off the period of FUD, the better. Your competitors, especially in down and dirty, contracting can be a down and dirty business. And let's say you're contracting with developers, not the public. You don't think your competitors are going to not talk to your developer? Hey, we got this new. You don't want to work with Joe. That business is up for sale, and I hear that. And then they start filling in the blanks.
Got one foot out the out the door. He doesn't care about the warranty. He's leaving soon. Yeah. I guess there are two perspectives on that because,
right.
I'm a CPA. I have to keep things confidential, but I also am very honest and I hate keeping secrets. Right. So, I wouldn't want to keep secrets from the employees, but you're right. As far as the clients, keeping the clients feeling good and that they're taken care of now and they're going to be taken care of in the future. You always have to have that same conversation, I think, with employees too.
And it's very contextual. Let's say you're in trouble and everyone knows it. That might be the best news to everybody. Oh, he's got a buyer and it's a real strong company. Oh, if that's a scenario where it reduces fear, uncertainty, and doubt, hell yeah, tell the world. But most often, this is a nice little business that's been humming along on autopilot, printing a nice little cash flow for both the owner and the employees. Everybody's afraid. I've been at, the other team's lawyers start coming through. And there's a whole lot of work involved in keeping it confidential. Actually, I talk about it in the book. Not so much that the importance of QT, but the importance of controlling how and when that information is going to be made. Because sooner or later, you got to tell them. But ideally, in a lot of cases, it's within 3 to 5 days of closing. Right. This is a done deal. Friday, or even the day off closing. By the way, this has happened. Let me tell you, everybody, not only do you not have to worry about your jobs, we're going to have a retention bonus in 90 days as a reward for the little bit of disruption that may occur. Nothing significant is going to change. This is a well-run company, and we intend to continue to run it the way it has been.
Do you have anything in there about the key management?
Yeah, we do. We talk about that. And that's more of the same. The company is nothing without its people. Every company is nothing without its people. Maybe second, it's contracts. You've got to keep people around. And so often you can have a whole another podcast on this topic, but retention bonuses of various sorts. Basically, you buy their loyalty. Because when you sold a company, that loyalty is not personal anymore. Basically,
you can say buy loyalty, but I think of it as hedge the risk, right? Because
absolutely
risk.
Because even if you buy loyalty after a period of time, it's not enough. You're just trying to keep them long enough for them to develop a connection with the new leadership and see that they will be treated right. In today's labor market, this is particularly true. If you've got a super salesman or a super technician, I promise you that person gets pinged every single week on LinkedIn. He or she knows what he's worth. And the minute there's any probability that this isn't going to go really smoothly, that person's gone. The people you most want to stay are the ones most at risk of leaving. In fact, loyalty is monetized by many small businesses, and often their A players actually could have made more money somewhere else and have known this for a long time. And you just severed the loyalty when you sold that business. So you usually have to be ready to raise people's pay.
Yeah, because they're staying for either the culture or the team that they like. So I can see that. That probably happens more and more, especially with the younger generation.
Yeah, it's interesting. People say that about the younger generation, but young people today rotate through jobs less often than they did in the 70s and 80s. I think people will hear about in the tech industry, but millennials have proven to be a fairly stable and loyal workforce in aggregate, much to many people's surprise.
Yeah, well, maybe it's because I'm in the accounting industry, right? Like the turnover here is in the industry, I think, is very high, but it's also depends on where you're at and what you want. We used Singer LUAC for the most part is 100% remote workers, and I used that 9 when I had my own CPA firm, and it didn't work on the recruiting side as much because I don't think people understood the value of that until they had it. Once they didn't have to drive an hour and a half to get into work, once they figured out that, they could take their dog for a walk at 7:30 and still be at their office and on time at 8, that they wouldn't give it up. So we stole a lot of talent from bigger firms and kept them forever. Like, I think I was the second employee to leave that firm, which is kind of crazy that it worked out that way. But that's what a difference it made. It means a lot.
So I think that's an interesting topic. Maybe you're gonna have another podcast on it, but I think that our company, we're used to remote work before COVID. Remote work is a lot easier said than done, and having remote workers be as productive as in an office is very dependent on having the right workflows, the right technology, and the right accountability. And there's a lot of studies. Harvard Business Review has studied this to the nth degree. It's been fascinating series. And they've come to the conclusion that all these studies that in general, there is an optimal balance. I say in general, because different, but you can't work remote at the fire station.
Right.
But in general, there's a balance of about 2 to 3 days at work and 2 to 3 days at home that enables maximum training, maximum culture building, and maximum flexibility. I feel that some industries, especially tech, are particularly well suited for remote, but industries where you're looking at, and even accounting, where you're looking at people who engage with others for a living, those people go crazy when they're remote 5 days a week.
Right.
We saw it in our firm during COVID. There were literally, I was worried about the mental health of some of my people watching this slide into oblivion that happens. And probably I was one of them. I've got to go visit the team. I love being around them.
Well, that's pretty awesome. And I see the team that you've been building there more and more often. I see them. When you and I first started, it was just you. That I know that you always had a team, right? But I see your team out and about in the business world more and more, which is pretty awesome. So congratulations on that.
Thank you.
I think that we're about ready to wrap things up. Is there anything else that a highlight or something that maybe we haven't discussed?
One of the things that this book talks about is the concept of a deal book. And it's just a term I coined. I tell people, start your 3-ring binder, your deal book, 2 to 3 years in advance, and do what I call due diligence in advance. It's almost like industries that get regulated are used to this. It's like a mock audit. When you go into the sale, the speed with which you get through due diligence is directly proportional to the probability of that deal closing. So if you've got your Dewey Decimal System, for want of a better, you've got an index system to get you through that due diligence. And that team says, hey, we need XYZ accounting history for 1, 2, 3. When you can pull that up in 15 minutes and email it back, that due diligence goes pretty fast.
Right.
If you're one of these where oh my God, I'm going to have to get the accountant, and the accountant's scratching the head, and 2-3 weeks later you get it back to them. The death of deals is time. Time kills all deals. So we talk about that deal book. And also in the deal book, it makes you think about how you would market it. And finally, what are you going to do next? Business owners tend to be unemployable. So you better have a plan. Start another business, or, get involved in some kind of charitable organization, or do something. Don't just sit and rot. And sort of final wrap from our perspective, we found that we're so well suited for these business owners. Successful business owners are frustrated by lack of attention to detail and communication from their advisors. At Avion Wealth, we're helping them not only build a wealth confidence plan, but we stay with them every step of the way as they navigate this process, manage their unique ability, which is running their business. And what they want is the knowledge. They want to be comfortable in the knowledge they got the right team, the right advice behind them, so that nothing falls through the cracks. And that's what we're here to do for our successful business owners.
Excellent, Paul. Excellent. Great. Like I said, I love the book, and the clients that you send my way, because they're just well prepared and well versed in this kind of stuff. So, if someone wants the book, and I know that you've got a new one out, give us some info so that they can reach out and get it?
Well, you can get it on Amazon, or if you just go to avionwealth.com, Avion, A-V-I-O-N, wealth, one long word, .com, and there's a place in there where they just, they can literally get a free copy sent to them. Be happy to send that out. Yeah, these quote unquote bestsellers, they're a service. I'm never going to get rich writing these books, but it's good content, and we're quite happy to share them with the people who most benefit.
Agreed. Well, again, Paul, thank you so much for coming on.
Thank you for joining us on today's episode of The Balancing Act by Singerly Whack. We hope you enjoyed the segment and gained some insight on how to keep your business balanced. You can tune in every Thursday morning to gain a sense of balance in this fast-paced business industry. You can listen on singerlywhack.com, YouTube, or anywhere podcasts are available. We'll see you next time.